While markets hit new records this week, the most profitable insight isn't about what went up. It's about what the crowd missed while celebrating. The S&P 500 reached an all-time high of nearly 7,000, but beneath that headline lies a system fracturing along predictable human lines. Today I'll show you how to exploit the psychological patterns creating tomorrow's opportunities while others chase yesterday's winners. The market revealed two competing emotional states this week. Technology stocks rallied on pure anticipation, investors positioning ahead of earnings from Microsoft, Apple, and the other megacaps before any evidence arrives. This is commitment bias at institutional scale. Having accepted the AI spending narrative, fund managers must now defend that conviction through price action, regardless of fundamentals. Meanwhile, healthcare insurance collapsed in panic. United Health dropped 20% in a single session after Medicare rate proposals came in far below expectations. This wasn't rational repricing, this was capitulation. When crowded trades unwind, the selling exceeds any logical adjustment to cash flows. The magnitude tells you everything about positioning and leverage. Here's what the system is actually showing us. The S&P 500 hit records while the Dow fell, creating a divergence that maps directly to concentration risk. A handful of technology names now determine index direction, while most stocks trade independently. Passive indexation has become a narrow bet disguised as diversification. The technical structure confirms this fragility. Equal weight indices briefly outperformed earlier this month, but money flowed right back into mega caps. This isn't optimism, it's defensive behavior. Institutional managers cannot afford benchmark underperformance if the AI trade extends, creating forced buying independent of conviction. Earnings season mechanics revealed the dependency. 83% of early reporters beat estimates, but that strength concentrates in technology and consumer names. The Magnificent Seven represent 30% of index value, yet the market prices in their success before results arrive. General Motors surged 9% on raised guidance, proving positive surprises still generate alpha, but healthcare's collapse shows the asymmetric downside when consensus breaks. The Federal Reserve meeting operates as theater rather than substance. 96% probability priced for no change, yet the event matters for narrative management. Markets seek permission to maintain positioning through dovish language, while political pressure on Powell introduces game-theoretic complexity, the volatility surface underprices. Bond behavior signals what equity investors ignore. 10-year yields at 4.25% with gold near record highs indicates fixed income doesn't share equity optimism. This divergence reflects different time horizons, but it suggests treasury markets price in outcomes that equity volatility surfaces do not. The AI capital expenditure trajectory reaching $470 billion across the hyperscalers creates path dependency. Once committed, these investments must be justified through revenue generation regardless of actual demand. The system now faces a profitability inflection point. Investors demand evidence that spending translates to returns, not just capex announcements. Here's the Stoic approach to this environment. The market rewards momentum until it punishes it. What works today creates the conditions for what fails tomorrow. Concentration in technology, front-running of earnings, and complacency about policy all represent vulnerabilities that manifest as opportunities when sentiment shifts. This is exploitable because human behavior remains predictable. Anticipation creates overvaluation in technology, while panic creates undervaluation in healthcare. The crowd reacts emotionally to single data points. We remain disciplined and systematic. The system shows us that aggregate stability masks individual volatility. Record highs coincide with sector-specific carnage, creating a regime where passive flows amplify both momentum and reversals. Technical patterns confirm continuation in the near term, but breadth divergence indicates fragility beneath index strength. Second-level thinking means recognizing that markets appear most stable immediately before they become most unstable. The task isn't predicting timing, but positioning for inevitability while managing exposure to its absence. History shows humans consistently chase recent performance while ignoring underlying structure. The Stoic exploiter maintains process discipline independent of outcomes, exploiting the gap between what crowds believe and what systems reveal. If you value systematic thinking over emotional noise, subscribe for frameworks that exploit human predictability rather than follow it. The complete methodology, including position sizing and risk management, is available in the description. Download it if you're ready to think like a system rather than react like the crowd.